Hello, Anthony. Thank you very much for joining us.
Not at all.
Perhaps if we could just kick things off with just a quick introduction to Futures and Options Association and yourself.
Yeah, the Futures and Options Association is one of several trade associations. It's a European association based in London, and its main focus is listed derivatives. And I guess because of growing convergence between the OTC and listed markets, it means we have to mop up some of the OTC area as well in our scope.
So clearly you're someone very much with their finger on the pulse of the upcoming regulations, the alphabet soup of regulations.
I'm not sure I put it quite that far, but I try to, let's say.
Well, I know obviously the original MiFID was very focused on the equities markets, but with MiFID II, it almost looks like it's going to take a broad brush of what they learnt from equities and apply it across all the asset classes they can find, particularly OCT and derivatives. But do you think that's going to be overall positive or negative?
Well, look, one size does not fit all. The Commission recognised that, but will it be delivered on the ground? It has to be if we're going to have properly differentiated regulation of differentiated markets. So that's the first point. I think in terms of negative against positive, it depends where you stand. If you like safe markets, if you're not particularly concerned about disturbing the traditional economics that stand behind market activities and risk management, then you might sort of say there's a positive over the negative. I don't stand in that position. I mean, I take the view that choice, diversity, innovation in the marketplace is really critically important. And therefore, I think I would argue, subject to seeing the detail, that we're more in the negative side than the positive side.
Sure. But is now then the time to necessarily be trying to deliberately make things more volatile, when is now not the right time for the regulations to be coming in to try and calm things down during what is, at least according to the media, an enormous crisis with the whole of Europe on the brink of collapse?
Well, look, effective regulation goes with the grain of market diversity and functionality. What I'm arguing for really is to say we want to see good regulation, we want to see effective regulation. What we don't want is regulation that actually compresses markets, because actually out there's a real need for end users to be able to use the markets to their maximum in order to manage their risks, raise money, etc., etc. So market compression, we need to be very careful about that.
Is that something that that is in danger of happening at the moment?
Yes, absolutely, because before the crisis, really it was largely end users were looking to direct and help to form the shape of markets to meet their needs. Right now it's changed, and I think the regulators are now directing the shape of markets. So there's a different kind of set of priorities at work here, and we need to be sure that we just keep diversity and choice and functionality in the place where the end users want it to be. And a lot of them are complaining and saying, actually, we're concerned about cost, we're concerned about market compression.
Do you think that voice is going to get heard, or is it likely that now that the train is already running with a lot of the regulations, that's going to end up giving way, I suppose, to the politicians and the tabloids?
Look, there's no doubt the voice is heard. The question is whether those who are listening are actually, how much they're taking that into account. I understand the drive for safer markets. I absolutely understand the drive for a sounder system. But we just need to be very careful to make sure that we've got a proper balance between the need for commercial repair and the need for regulatory repair. And I'm not sure we got the balance right.
So if we can just move on, how will the creation of OTFs by interdealer brokers affect futures and options trading? Well,
the first thing is, I personally believe and not everyone would agree with this, but I think it's a good thing that OTFs are inside the tent of an organised venue as opposed to being outside. Now that said, it's a fundamentally different execution platform to a regulated market. And therefore what we need to have is regulatory differentiation that recognises those differences. Regulation that isn't just the same rules because it happens to be a platform, but actually rules that are properly risk-based, properly recognise that OTFs will necessarily be smaller markets, they will be more specialised, and therefore we need to accommodate that.
So can competition exist in exchange-traded derivatives?
Yes, it can, and it should. But I think this exists only up to a point, because as we all know, market liquidity tends to stick where it is. So it's very difficult to move liquidity in a given range of products from one exchange to another. And at the same time, I think it's equally fair to say that market users now are getting increasingly concerned about the cost base of their trading activities for all sorts of reasons there's no need to go into. So they will be looking for what's the best deal I can get in terms of margin offsets, what's the best deal I can get in terms of exchange fees, and therefore it's largely going to be driven by those kind of criteria as well as the quality of the marketplace and the depth of liquidity.
I know you said we weren't going to go into the cost, but one thing that of course has been in the headlines a lot lately is this so-called Tobin Tax. And well, possibly that says it all right there. And I can't, from my perspective, see how, from the point of view of the very people that are meant to be involved in it, how it can be good for anyone.
It can't be. And it won't be. Yeah. And the expectations that somehow it will reduce speculative activity is in itself a nonsense, because that's being addressed in other criteria, in other contexts. And it's not only nonsense, but actually if you're going to be taxing legitimate hedging activities in the same way that you're tackling any other form of trading, and don't forget it's cumulative, so every transaction is subject to a tax. So in other words, the cost of it is going to be very high. Its ability to drive business offshore is going to be considerable, and therefore the expected tax take is going to be much smaller. So I don't think it makes sense on any ground whatsoever.
Do we think it's still going to actually end up going ahead then?
Well, an individual nation, an individual member state can introduce it, a group of member states can introduce it, but in terms of being introduced on a compulsory basis across the EU, we already know the UK's position, the Swedish position, and they've made it clear that they will exercise the veto if they have to on this.
It'll be interesting to see how it plays out. Now, just looking at algo trading for a moment, which is, of course, obviously one of the things the Tobin Tax was meant to try and curtail in some ways. How are you seeing futures algorithms and their deployment strategies developing? And what are the latest trends that you're seeing in this area?
Well, I think you have to start from the premise of, firstly, this is technological development. It's as simple as that. We've gone from chalk and board, we've gone to open outcry pits, we've gone to program trading, and so on and so on, and now we're at the position of algo trading. And I think personally algo trading will become much more the norm as it begins to become more widely accepted. And already it's moved way out of the context of just proprietary traders using it. So in other words, I think it's going to be a basic methodology for trading in the marketplace. And the real issue behind all of this is to make sure, if I can put it this way, that the risk management of algo trading is as high frequency as the execution itself. In other words, the risk management process keeps up with and is running in parallel to the speed of execution. I mean, that's the critical thing.
Sure. What are the main things that people are getting wrong then?
Well, I'm not sure people are necessarily getting them wrong. I mean, I think there's a program for regulatory repair, parts of which we would entirely agree with and parts of which we don't, like leaving algos resting in the marketplace in a declining market is just going to increase risk to the market participants and the end users. And I don't see the point or the need for that, because actually that sort of compelling high-frequency traders in some way to be market makers is going to change their risk profile fundamentally. Why would you do that? Just because of the speed of trading, suddenly say, well, actually, we want you to stay in the marketplace. Differences in speed of trading have always existed, right back from the days when people rode horses up to the top of a cliff to see the masts of cotton ships coming over the horizon. You're going to say everyone has to use mules.
I suppose this goes back to one of the proposals that was in MiFID, the idea that you have to keep your algo continuous throughout the trading day. Yeah. This also seems like one of those things that has been put in to appease politicians, but hasn't necessarily been thought out in full.
Well, I don't think it has been thought out in full, because you're going to exacerbate, as I say, the risk of the market participant by forcing them to stay exposed in a marketplace where there may be extreme volatility, or the market may be declining for all sorts of reasons in terms of liquidity. And you say, well, actually, you've got to stay in there. We all know what risk that is going to generate.
And yet again, another reason why people might start looking to trade elsewhere then.
Well, that's true. I mean, but all I'm trying to say is that this is about risk management. This is the critical issue, is to make sure the risk is tracking the pace at the same pace and the same speed as the execution process itself. And I can understand all the arguments that say, well, algo trading shouldn't be a vehicle for market abuse. Of course it shouldn't, but then nor should any other form of trading. There's nothing particularly unique about algo trading that suggests that it's more susceptible to market abuse than any other form of trading.
It's just about making sure that those attempts to curtail the abuse are just they're well thought out and aimed purely at the abusers, whereas it seems that they're just going, well, we don't know exactly who's getting wrong, so we're just going to make a big broad brush piece of regulation.
Absolutely. If you're going to say, look, we need additional regulatory controls over high frequency traders for all sorts of reasons, if you identify why that form of trading is more susceptible to market abuse, then you introduce more controls to deal with that additional susceptibility. But I'm not convinced that we've seen the evidence. If we see the evidence, absolutely fine. Because once again, regulation has got to be tailored to the service and the activity that it's trying to deal with.
Well, with your regulatory future crystal ball on, how much do you think will actually of these proposals end up going through, and do you think it'll end up being completely different to what's been introduced so far, or roughly?
Oh no, some of them will. I mean, the requirement that they will have to all be authorised will go through. The requirement for tougher risk management standards will go through. The requirement for exchanges to be able to better monitor the processes and the activities that are taking place, all of that will go through. No problem with any of that, because those are, if you like, areas where there's been some identified regulatory weakness that needs to be addressed. Absolutely fine. But what we must be careful about is not just to introduce regulation for regulation's sake, because there's unevidenced fear about what the possibility of that form of trading can deliver. It's got to be evidenced, and then you deal with it.
Well, finally, because we are almost out of time, in your panel session at this year's Trade Tech, you're going to be examining developments in listed and OTC derivative regulation and how market mechanics are evolving. At this point in time, because obviously things may have changed come April, what are your opinions?
Well, it almost takes us back to the first question, that the need for regulatory repair is self-evident. We've gone through a crisis, everyone would recognise that. What's very important, though, is we keep a balanced and proportionate approach, and that we actually, again, I'm repeating what I said earlier on, but that if we are going to actually have an improved marketplace, it also means improving the functionality of the marketplace, the diversity of the marketplace, allowing consumers to choose their execution methodologies, etc., etc., etc. And therefore, what's important is we get a proper balance between the drive for regulatory repair on the one hand and the need to facilitate economic recovery and commercial repair on the other. And the latter requires open access to the marketplace and economically driven access to the marketplace. So we need to be careful about pumping up cost on the side of regulatory repair at the cost of commercial repair.
Well, thank you very much for speaking with us today. It's been fascinating. If people do want to find out more about the Futures and Options Association, where can they go?
Well, they can certainly ring me, or they can ring our membership manager. Yeah.
Fantastic. And I believe it's foa.co.uk?
Yes.
Fantastic. And if you, of course, want to find out more, see more interviews and download various white papers and reports, you can get them all from www.tradetecheurope.com.